Welcome to this explainer. Look, if you're out there running a trucking business today, I definitely don't need to tell you that operating costs are just through the roof right now. But there's one specific line item that's probably giving you actual nightmares. Yeah, we're talking about the massive, totally overwhelming pain point of trucking insurance premiums.
In fact, our source material hits the nail on the head with this quote. Trucking insurance is crushing owner-operators right now. I mean, that's a reality you likely know all too well, right? It's honestly evolved from being just another cost of doing business to becoming the absolute biggest expense for a lot of operations.
To put the sheer scale of this into perspective, we're seeing fleets currently paying $20,000, $30,000, or honestly over $40,000 a year just to keep a single truck legally on the road. 40 grand, that is a staggering number. And the sad part is when you're desperate to cut those costs, it's so easy to try and save money the wrong way, like buying weak coverage or hiding info. But today, we're going to look at how to lower those premiums the right way. Okay, let's dive right into this. We're going to map out exactly how to shift your risk profile by looking at 5 key areas underwriters evaluate. We'll cover the underwriter's lens, prioritizing driver safety, maintaining your fleet, smart business operations, and finally, avoiding dangerous shortcuts. So, starting off with area number 1, the underwriter's lens, and exactly how risk is priced. Now, before you can even think about lowering your premiums, you've got to get inside the head of an insurance company. They price based on perceived risk. And you know what their absolute biggest fear is right now? The nuclear verdict. Underwriters are quite literally terrified of these modern trucking lawsuits where jury awards are topping $10 million. $10 million! Add cargo theft, distracted driving, and crazy high medical inflation to the mix, and you quickly see how a single accident can cost millions. So your primary goal here? Make yourself look as low risk as possible to these super strict underwriters. Moving on to Section 2, prioritizing driver safety. This is really the foundation of lower rates. So the people behind the wheel dictate your risk profile more than almost anything else. You might be wondering, why exactly do safe drivers pay less? Well, it sounds obvious, but underwriters are just playing the odds. Insurance companies absolutely love clean driving records, lots of experience, and low accident histories. Why? Because mathematically, those things drastically reduce accident probability, your exposure to lawsuits, and the overall frequency of claims. Let's look at how this plays out in the real world. Your motor vehicle record, or MVR, is heavily scrutinized. We found this real example in our source material where an owner-operator got hit with just one reckless driving citation. Just one! And because of that single violation, their insurance renewal jumped by thousands of dollars for the year. It's crazy to think about, but one bad decision behind the wheel completely flipped their underwriting risk. Literally, one risky driver can blow up the rates for an entire fleet. And hey, beyond MVRs, your CSA scores matter immensely too. Underwriters are digging into your inspections and your out-of-service percentages. We're talking about things like brake issues, tire problems, hours of service violations, lighting defects, and load securement issues. To an underwriter, looking at a poor CSA score filled with those kinds of violations is basically a glaring, flashing neon sign that screams unsafe operations. All right, Section 3, maintaining your fleet. We're talking equipment and compliance here. You know, equipment and compliance really go hand in hand with driver safety, mostly because poor maintenance is basically an open invitation for lawsuits. Let's imagine 2 fleets applying for insurance. Fleet A has everything in order, documented training, safety manuals, dash cams. Fleet B? Nothing. Zero. It's really no surprise that Fleet A gets much better pricing simply because they are organized. It's a fact. Insurance companies just love organized carriers. So, if you want that better pricing, you've got to build a rock-solid safety program. It boils down to 4 key steps: doing regular driver training, having actually documented safety meetings, conducting thorough accident reviews, and keeping strict tabs on compliance monitoring. Having this level of documentation on hand just instantly proves your credibility. It makes your whole operation look like a much lower risk. And a really massive piece of any modern safety program is the tech, specifically dash cams. Guys, these are your absolute best witnesses out there. They fight off false claims, they defend against those terrifying nuclear verdicts we talked about, and they stop fraudsters dead in their tracks because they provide hard, concrete evidence. Tons of insurers absolutely love dashcam programs. Many will even actively offer you underwriting advantages or straight-up discounts just for having them installed. Okay, let's look at Section 4, Smart Business Operations, and how they reduce your risk profile. This is where we step back and look at the broader picture, because the actual type of freight you're hauling has a huge say in your premiums. Underwriters put your cargo under a microscope. If you're hauling high-risk stuff, think electronics, pharmaceuticals, alcohol, or tobacco, it's simply going to cost more to insure. The same goes for running reefers. Reefer trucking brings in temperature exposure and spoilage risks, where just a single rejected load can easily top six figures in damages. Naturally, that level of risk bumps up your premium. Now, here's a crucial takeaway about how you handle small issues when they inevitably pop up. Insurance companies review your loss runs, right? Your claim history reports. What a lot of truckers don't realize is that filing a bunch of minor damage or small cargo claims actually works against you. To an underwriter, seeing frequent small claims suggests operational instability. It hints at a weak safety culture and future claim exposure. So honestly, sometimes just eating a small loss yourself can completely save you from a massive premium hike come renewal time.
And if you're running a brand new authority, I know the pain. The lack of operational and claims history means underwriters just don't have confidence in you yet. That's why first-year premiums are usually painfully high. Take this real example from the source. A new owner-operator was hit with a first-year premium of $32,000. Ouch. But after establishing 3 clean years and a really strong safety record, that premium dropped significantly. The takeaway? Stable operations will bring your costs down over time. Hang in there.
Finally, we're at Section 5, Avoiding Dangerous Shortcuts and Why You Need to Play the Long Game.
Look, when premiums are squeezing your margins, it is so tempting to look for a quick fix. But underwriters constantly see truckers trying to lower premiums through incredibly dangerous shortcuts. Things like hiding drivers, using fake garaging addresses, understating their operating radius, or hauling undeclared cargo. You really have to contrast those with smart strategies, like keeping your MVRs clean and installing dash cams. There's actually a crazy example in the source of a carrier who claimed they only ran local dry freight, but they were actually hauling nationwide electronics. When cargo theft happened, the insurance company completely disputed the claim because of those undeclared operations. Cutting corners like that can backfire catastrophically.
Which leads us to a really critical realization. The absolute lowest premium is not always the best value. Cheap insurance policies are notoriously packed with weak coverage, hidden exclusions, and very limited protection. Honestly, paying a rock-bottom price means absolutely nothing if a denied claim ends up completely destroying your business. The smartest trucking companies focus on long-term value and robust coverage rather than just chasing the lowest sticker price. Ultimately, bringing down your premiums isn't about playing tricks or hiding information. It's about building a fundamentally safer, more professional business. So, I'm going to leave you with this question to think about. Is your trucking business currently projecting dangerous risk or professional stability to your underwriters? Remember, every single ticket, every small claim, and every maintenance violation pumps up your perceived risk. Choose safety, organize your operations, and you'll watch those costs come down over time. Thanks so much for joining me for this explainer, and hey, keep it safe out there on the road.